In this video, we're going to take a closer look at analysis, and we're going to kind of look deeper inside some of the numbers that we see. So the first thing we want to look at is something referred to as the Dupont equation. And the Dupont equation revolves around trying to understand those things that influence return on equity. And there are really three kinds of decisions that improve return on equity. Before we get to talk about those in particular, let's look at the math in the formula. So we have net income divided by sales multiplied by sales divided by total assets. So if you multiply those two things together, sales divides out. Now over here we had total assets, sales divided by total assets, multiplied by total assets divided by equity. And if we multiply those together, you have total assets divides out, and you're left with net income divided by equity, which is the formula for return on equity. So what does this mean as far as understanding management's decision and their influence on profitability for owners? If you want to increase profitability for owners, there are three things management can do. The first thing they can do is make more money, right? Become more profitable. Find ways to decrease the cost structure of operations. Next, they can become more efficient with their asset base. Find out if they have assets that are obsolete, right? Review the current lifespan of assets. Maybe we can find ways to decrease our asset base and still maintain high levels of operations and quality, increase the efficiency with which we're operating our company. And finally, and this is the one that most people have some issues with, is we can find ways to increase leverage. How is that possible? How is it possible that just borrowing more money would increase return to shareholders? Well, let's just kind of think about the balance sheet first. We have debt and we have equity. Let's assume that what we're going to do, we're not going to change our assets. We're not going to change over here. All we're going to do is borrow some money and move our debt down here, right? So now our equity is here and this is debt. So we have a lot more debt than equity. If the assets are producing the same as they used to, net income should be the same. So profitability should be the same. Total assets, the efficiency should be the same. What will change, though, is of the profit that is made, it is now going to be divided by a smaller set of numbers. So equity itself decreases when we substitute debt for equity. So increasing leverage should have the effect of increasing return on equity to investors. Now that also, no, it doesn't say it's the right thing to do, but it also, because it really doesn't look at risk. If you increase it too much, you may increase the riskiness of the company beyond where you want it to be. So if we look here at the Dupont equation for Coca-Cola, again, let's ignore the first year because that's messed up because of profitability. But if we go across the board, if you look, we have what? Relatively stable profit. We have relatively stable efficiency. But our financial leverage multiplier seems like it's declining, so it's going down. So what do you expect? If leverage is going down, what should be happening to return on equity? You see, seems like there's a little bit of a downward slope happening here. So how can this company improve, right? Again, can they make this number go up? Can they become more efficient? Can they find a way to increase the leverage of the company? If they can increase any or all of those things, we should see an increase in the return on equity for the firm. So now let's look at what happens as managers and we analyze a company. What happens if we want to make a change? We see something that we don't like and we want to make a change. So let's look at, in this case, we're going to talk about receivables. So this company has $6.9 million in sales. Out of 365 days, that gives us $18,905 a day in sales. So what would happen if we can reduce our days sales outstanding to 32? Again, I can't remember exactly where it is. They'll tell us here this in a second. Right? It's currently at 46. So under the old accounts receivable, how much accounts receivable did we have? Well, we sell roughly 18,905 a day, multiplied by the 46 days. That gives us accounts receivable about $878,000. If we can lower that, means essentially we're trying to lower accounts receivable. We have the same amount of sales. We're getting paid quicker. We should now have accounts receivable about $604,000, which means we're going to free up $273,000. So this is initially going to show up as an addition to cash. So what should we do with that extra cash, right? We could invest in something. We could pay off some of our debt. We could increase our dividends. We could buy more plant and equipment. It's not a huge number, so maybe we just want to put it in a interest-bearing account in case we need that cash for some kind of an emergency. How would that affect the stock price? Well, what we're seeing is all of those things would be reducing some form of burden, either reducing the risk of the company or reducing some of the debt of the company. We would think that maybe that would have a positive influence on the stock price. It should be reflected in a lower risk for the company in general. So once we make a change, or once we think about making a change, we have to think about what does that change do to affect the rest of the company? How is it going to filter through in the financial statements? And again, here, we can rebuy stock, expand the business, reduce debt. And all of those could improve the stock price. And just as kind of a conclusion, let's talk general about ratio analysis. What are the problems? Making comparisons to industries is difficult because most companies are not conglomerates strictly from that definition. So a conglomerate is a huge company that is comprised of many, many different industries, most of which are unrelated to it, right? But essentially what we're saying is, if you think about Anheuser-Busch, they obviously make beer, right? But they're also involved in the microbiotics industry. They're in the canning industry. They make glass, right? They're also in farming, right? All of those different industries are all under the Anheuser-Busch label. Let's not forget the theme parks, right? So all of those, the data from all of those different divisions are all under the Anheuser-Busch label. So comparing Anheuser-Busch to Molson Coors, for instance, isn't strictly a straightforward kind of comparison. There's going to be a little muddiness, if you will, in any analysis that we have. We also have to look for different types of practices in operation, both accounting and operations. Sometimes it's hard to tell whether a ratio is good or bad, right? We have to understand the relationship inside the company, and obviously we have to understand what the ratios are really telling us. It's kind of difficult to tell whether the company is on balance in a very strong position or weak position because they have so much data that talks about so many different things. Again, some other things just finishing up here. Average performance isn't necessarily good. You probably would like to be above average. Seasonal factors can distort ratios to a certain extent. Managers will sometimes deal with things called window dressing. They will do things that make the company look better, but all they're really doing is doing some accounting changes, right? So, we like the company to be very liquid, which means we want to have relatively low current liabilities. What if I take out a 5-year loan and pay off half of my current liabilities? My current ratio, quick ratio, those liquidity ratios are going to increase substantially. But all I really did is change the maturity of the debt. I moved it from something less than 365 to something more than 365. So did we really do anything at all for the company? And I would say the answer to that's probably no. We also know that inflation is a problem, right? Especially in today's economy, the inflation rates today are distorting balance sheets left and right. So how that is going to fix our interpretation, making comparisons to history, we're going to have to take that into account for this year. If it clears up this year, no problem. But if it happens year after year for the next several years, how we're going to make comparisons to history is going to be very difficult. So again, those are some of the issues dealing with financial analysis. I hope you enjoyed the video. Look forward to talk to you soon. Bye-bye.